what was it? Liberation Day. They're back higher than they were at Liberation Day when the markets tanked. And I was thinking,
Liberation Day.
there's been like so many news stories that are like once in a year in the last 30 days, it feels like. Anyway, the Liberation Day, whatever that was supposed to mean. But there was a lot of fear and panic. The markets essentially went to a bear market. We were intraday 20% down on the S&P 500.
Like the beginning of COVID.
Yes, and now it's recovered so quickly.
That's right.
And I was thinking about this. Markets have always recovered, and they always will. But typically, bear markets the average bear market's about 9 months of declines.
Of going down.
Down, down, up, down, down, up, down, up, down, down.
And before
up,
it finds before it hits a bottom.
9 months.
And we're using the definition of a bear market.
20%.
But that's
fall.
not technically the definition, but we're going to use that.
It's a made up definition. It's not like
all right. Okay, it's
mathematics or science.
Fair enough.
But it was so short, and I was thinking, like at the start, we're like, don't panic. Like this will too pass. We'll hit no highs again. And I don't like being not proven right, but I guess kind of proven right so quickly because there will be a bear market.
That's long.
And if you went through this and it caused a lot of stress and anxiety, maybe you have more in stocks than you should or need.
Yes.
And if your lifestyle is not dependent upon you having 70 or 80% of your portfolio in equities, and you had a lot of fear and anxiety the last couple months, maybe this is a good opportunity for you to pare back a bit and diversify away from stocks a bit.
And rebalance your portfolio.
And rebalance that portfolio because...
And by the way, you should be...
We'll have another downturn.
People, I think one of the biggest mistakes people make in their portfolio, especially in IRAs and 401ks, is that they don't rebalance them on a regular basis. They don't have an investment thesis. And the other is...
That's because when things are going up, why would I want to get rid of this fund? It's doing so well.
Well,
this
I
stock
understand why it's doing, but it's still a mistake. It's still a mistake, even though we know why they do it. Right? Pensions don't do it. Pension plans don't let their portfolios run forever. We don't let our clients' portfolios run forever.
Of course not.
Yeah.
Because we have an investment thesis going into things.
Correct. And the other is tax, not paying enough attention to tax.
But look, there will be another, like if you look at last 25 years, two major bear markets, right? The financial crisis.
Oh, yes.
Which was mid-2007 to February or March of 2009. So it was a long one of new lows. Then, of course, it recovered. Before that was in 2000 to 2002. It was 28 months, 29 months.
And that's when was the bonds? What year was that? Where the bonds just did terrible.
94?
Yeah, it's 94.
Now you're dating yourself. Anyway, but the time to reduce any sort of asset class, you don't want to sell when it's down. You want to sell when things are up, right? That's kind of like they talk about the first day of finance class.
But it's hard to do.
Buy low, sell high. Things are high, expensive. Now is the right time to looking at rebalancing and having the appropriate portfolio for yourself if you didn't have it already.
And especially, as you said earlier, if you were nervous through this whole thing and were like, it probably is a good check that you are overweighted equities.
If you've got enough assets to maintain your lifestyle without that risk. If you find yourself in a situation where you're not going to be able to make your cash flow needs the next 20 years without having equities, then you've got to either figure out
how to live on less,
either live on less or live with the volatility. Those are your options.
Yes.